traders and investors, welcome back to the Trend Trader channel. Today I'm going to be discussing something based on the question that I asked on the Trend Trader channel. Basically what I asked on that community tab was which topic should we cover in our next video. Then somebody responded that we should cover when should we sell our stocks. I will show you the question so that you can see. But what I'm going to be doing in today's video is answering when we should sell our shares. So there are so many ways we would want to sell our shares. It could be that we are cutting our loss, or we are selling our shares because we have made profit on that position, right? So I have my book with me here so that I can check what it is that I need to cover, so that I make sure that I give you proper information, not necessarily perfect, but proper information in a stepwise manner, right? So like I said, there are so many reasons why we would want to sell our positions once we have bought the companies, right? It doesn't matter how you chose that specific company. At the end of the day, you need to have a risk management strategy in place. Without a risk management strategy in place, irrespective of the style that you use to pick your investment or the stocks that you want to trade, you can just easily blow up that account or give back the gains. So that is why we're having this video, right? The first reason we want to sell a particular position, we can sell, like I said, you can sell that position for either for profit or loss, but we're going to first cover the loss part, right? So the reason why you want to sell is because you bought a company and the company is not performing the way that you expected it to perform. That could be based on the business itself, if you consider yourself to be an investor and you use fundamental analysis. Or in terms of just risk management perspective, you are selling because the share price is dropping. You buy something at 100 Rand per share, you're expecting the share price to move up, but after some time, whether it's days, weeks or months, then the share price it starts to decline, going from your entry level to levels below than your entry levels. Then it is important that you do cut your loss in that case, right? So depending on how you set your stop loss, I personally set a maximum minus 10% stop loss on most of my positions, but this is not just a number that I pick anywhere. This number is based on the structure of the market. I'm looking for area of value. Every time when I buy something, I prefer to buy it next to an area of value, so that when I'm going to set my stop loss, it should be some place that makes sense based on the structure of the market, not just to pull up a number, say minus 10%, and say if the share price drops by minus 10%, then I'm going to exit that position, right? So I do sell my losses. I sell them real quick. I don't compromise. I don't want a position to go beyond minus 10%. Each and every position that I have in my portfolio, when I set a stop loss, the stop loss is between 1 and 2% of the total value of that particular portfolio or of my portfolio. So if I take a minus 10% loss on a particular name, it means that I'm losing about 1% or 2% of my portfolio. So if we're just gonna stick to minus to 2%, for example, it means that at my portfolio level, I have 50 chances to try and make money in the stock market. The 50 chances come from the portfolio is 100% value divided by the 2% that I'm risking in the market per position. Then I can try to trade 50 times before I blow up, assuming that all the 50 trades are losses. If you have 1% loss, then you have 100 times to try and make money in the stock market. So just that on its own, it gives me a chance to actually make money, because, well, unless you don't know what you're doing, 50 chances is a lot, right? Like I said, that minus 10% is not just any number that I use. It's also based on the volatility of that particular security that I'm buying. Some securities are less volatile, whereas some securities are more volatile. So you need to take volatility into consideration. Volatility is just the rate of change in price of the share price, because we are speaking about the share prices of the stocks that we buy or trade in the stock market. So a share price that has a volatility of say 5 rand per share, then you can take multiples of that volatility, like 2 times ATR. Then you expect that the share price can be volatile by at least 10 rand at any time. So if you start to see the volatility going beyond 10 rand, let's say 15 rand change in share price, especially if it's moving against you, then it's showing you that now that share price is too volatile, right? There's nothing wrong with volatility. We've covered this topic. Volatility is two-sided. We are interested in the positive volatility, because without volatility in the stock market, we're not going to be making money, right? So I do sell for a loss. Always, I don't compromise. I don't believe in that you only lose when you sell, because you can be wrong in the stock market and then you're just going to lose money there, right? So the other question was, when do you accept that you are wrong? For example, your analysis is incorrect or the timing is incorrect. So if you buy something at 100 rand, it does not even go to 110. It just goes straight to 90 rand or 8 rand. Then you need to accept that you are wrong on that particular analysis. There is no need to try to be right in the stock market. The stock market is not interested in your opinion. It doesn't care whether you think that you are right or you are wrong, or you think that you are right and the stock market is wrong, right? So once the share price starts to move against you, especially by a certain amount with the preset stop loss, then you need to exit that position. Sometimes you buy a company, it does not go up, it does not go down, it just keeps on moving sideways, right? Maybe you can give it a week to see where that position is going. Well, if you are too patient, you can maybe even give it a couple of weeks. But let's say after 3 months, the position is not going anywhere, it's not volatile, it's just stable sitting there, then I also use something I call a time stop, because in the market I need my money to be working, to be making money for me, well, unless I take a stop loss. So once I see that the position is just dead, it's not going anywhere, then I use what I call a time stop. I've given this position enough time to work out, but it failed to work out. Then I need to close that position, not because the stop loss is hit or because the take profit level is hit. I'm just saving myself from wasting time in the stock market, because while that company is just sitting there moving sideways, not going anywhere, there are companies that are either going up or down, where my capital could be better invested there and making money. So yes, you need to have a stop loss, so that if the market goes against you, you can sell. Then you can also use a time stop, so that you don't sit in a dead position for far too long. In the JSE, there are plenty of dead stocks like Nutritional Holdings, Imbali Beauty. You can buy those companies for next to nothing, but you are not getting anything out of them, besides that you are excited that you have a lot of shares, right? So now, when do we sell for profit? Because that is something that does bring a smile to my face, right? Exiting for a profit is easy if you predetermine your levels. Remember, before you take a trade, you need to have preset levels. The levels where you're going to exit if you are wrong, that is your stop loss, and the level where you're going to exit if you are right, that is your target, right? Having a target on a trade, it differs from strategy to strategy. I use a long-term trend following. So for trend following trades, I don't necessarily have a target, but I keep on tracking my position. As the share price move up, I keep on lifting my stop loss, and I trail that price as it moves up. Once the market turns, instead of going up, it starts to go sideways, I raise my stop a bit, and then once the market now turns, it starts to fall, then my stop loss will be triggered. But now that stop loss will be triggered far from my area, so now in essence my trailing stop loss is now becoming my take profit level. That is for long-term trend following trades. I also do swing trades. Swing trades are simple. You just buying a stock at a certain level, and then you preset a take profit level, that okay, if you are right, if the price move in this direction, it's going to move by this much, or at least you expect it to move by that much. Once it reaches that level, then you close that profit. You close that particular particular trade. So with swing trading, it's much simpler. You just need three things: the entry price where you're going to be buying the shares, the stop loss where you're going to exit if the share price move against you, and then the take profit where you are going to exit with profit if the share price move in that particular direction. But you cannot just place a trade and then in the middle of a trade then now decide that, okay, I'm going to do this or I'm going to do that. You need to have that plan before you take that particular trade. The reason why you need to have that plan before you take a trade is because this is going to assist you not to panic. At any time, you will know what to do in the market. Whether you are hearing good news or bad news, or you're hearing people talking about a particular company, a company that you have in your portfolio, there's no need for you to panic because you had conviction when you took that position. Whatever conviction, whether you did your fundamental analysis and you took the trade based on fundamental analysis, or you did technical analysis and you took the trade based on technical analysis, it's your conviction. Nobody can change that for you. You need to know why you are buying a particular company. So in essence, the news, they just don't matter. You need to focus on the game that you are playing. How are you playing that game? Because before you buy or sell something, you really need to think about the entry and the exit, and then you won't panic. The share price can just go up and start to move back. If it hasn't triggered your stop loss, there's nothing to panic on that particular position, right? So for my swing trades, I normally take between 2 times or 3 times the risk. Let's say, for example, I'm buying a company that is trading at 100 rand per share and my stop loss is 90 rand, meaning that on that particular position, if it goes against me, I'm going to lose 10 rand per share. Then 2 times is 120, 3 times is 108. You see, so once I take that particular position, then I know when I'm going to exit. If I'm wrong, I'm exiting at 90, taking that 10 rand loss per share. If the stock share price, it goes to 120, then I can sell it, or if it goes 3 times, then I can sell it. But the 2 times and 3 times, it's not something that you just pick from the sky. It is based on the records of my trades. I know that, okay, if I trade this particular setup, I can make maybe this much, right? It's not like, I mean, I would wish to make 100% plus returns on my positions, but if you are trading maybe a range breakout, for example, the stock has been moving sideways in a nice rectangle. Once it breaks up, the least that it can go up, it's by the same size of a range. So if the stock has been trading in a 20 rand range, once it breaks above a particular range, then you expect the price to go and reach a 20 rand move upwards. So it wouldn't make sense to have a take profit that is 50 rand, because I mean, the logical way that a particular share is expected to perform is to just go up by 20 rand. Or even if you trade, let's say you trade chart patterns, you are trading inverse head and shoulder, there's a specific amount that a head and shoulder can move based on the structure of the head and shoulder itself. So then you know that, okay, if you enter once the stock break above the neckline, you set your stop loss at a certain level, then it is expected that based on that chart pattern, the share price can go up by this much. Then that is how you set your stop loss. But ideally, in terms of risk to reward, you need to ensure that every trade that you take, there is a good enough chance for you to make more money than the amount of money that you can potentially lose. That is why in our videos we always say that at least the risk to reward ratio should be 1:2, meaning that you should risk 1 rand to make at least 2 rands. So if my take profit level are 2 times or 3 times, it means that I'm risking 1 rand to make between 2 rand and 3 rand. And then this is important because for you to have this, to know the reasonable risk that you should take and with the potential reward, you also need to know your win rate. Out of 10 trades based on a particular setup, how many trades were profitable, how many trades were losses. Then if you use the combination of the win rate, your average losses and your average gains, then you can determine if the trading strategy that you are using does have an edge. What is an edge? An edge is a positive expectancy. It's just the probability of one thing happening over another. Let's say now, based on your win rate, your average losses and your average wins, you calculate your edge, you find that you have a positive expectancy. Then you know any trade that you take, you know that trade has a potential to work out. That is not based on the company. That, let's say for example, if you are buying Sasol has a positive expectancy of working. If you are buying Shoprite has a positive expectancy. If you buy Pepco has negative expectancy. No, it is based on how you choose companies. I use technical analysis, so I know that if, for example, I'm trading a breakout is more likely to succeed compared to, say, the pullback. That is why you rarely see me saying that we are buying a dip. I don't have a problem with buying a dip. I don't always buy a dip because based on my trading result, the dip does not always work well for me. For other people, it could be their best entry. Or let's say, for example, you are trading cup and handle pattern. That pattern has a higher success rate. I think it's about 60% win rate. Then it also has a specific amount where it can go up. Why it can only go up by a certain amount? It's market participants' psychology, right? For example, if you look at the share prices, at the even numbers, the share price can go up and stall there, because if the share price move from 100 rand per share, between 103 rand and 107 rand, nobody really cares about that share. But once it reach 110 rand, then people start to pay attention. They expect the share price to stop moving as fast, if in case it was moving fast. So that is the trader's psychology. Everybody's just sitting to see what is going to happen around 110. Then the share price break 111, 112. Then it starts to move up, because between 112 and 107, nobody cares about the values in there. But once it's closer to 120, that's when people start to pay attention. It's the same thing that makes the chart patterns to work, because people, they expect that, okay, once they move by this much, then you expect this. Whether you are using a Fibonacci retracement or you are using trend line, any chart pattern, for example, it is driven by market psychology. People have seen this thing happening in the past, and then they expect that thing to happen again. Not necessarily that it is going to happen, but they just expect it to happen, and then they start acting on that, right? So I've mentioned that my average profit level is 2 times or 3 times my average loss. That is because you need to record your trades, so that you know how much money you are making if you're profitable, and how much money you are losing if you're losing. Then you try to make multiples of the amount of money that you lose whenever you are correct. Then I've mentioned that they take profit. We don't just decide where it's going to come from. We also need to take into consideration the structure of the market. If there is a resistance level that you need to be mindful of, because if the price is moving up and then it has an overhead resistance, then we can expect that share price is going to have a bit of an issue once it reaches that particular level. Some people use Fibonacci extensions. It's just a mathematical thing. You draw the Fibonacci from the high and the top of that particular price. I don't use a Fibonacci. For those that don't use it, I don't want to give the incorrect interpretation on the use of the Fibonacci levels. But again, the Fibonacci levels are also psychologically driven, because people expect that, okay, once the stock move by this much, or the 61% or so and different percentages, once the stock go up by this much or down by this much, then they expect the share price to stop moving too fast, and then maybe consolidate a bit before it takes on another leg, whether it's moving up or it's going to move down on that particular level. People that trade Elliott wave theory, they know that there are some impulse move and corrective move. Well, not sure if it's impulse or impulsive, but there's a main move and a minor move. So they know that the main move, if it went up by this much, the corrective move can potentially go down by this much. Then they can trade, maybe they can plan the next major move, that, okay, once the minor move has went down by this much, they expect the next major leg to go up by that much. Then they can set a take profit based on that. You see, everybody has a plan. You do need to have a plan in the stock market, so that you don't just trade based on hope, right? Then, like I said, for trend following, which is different with swing trading, I just trail the price, meaning that I follow the price. As the price move up, I just I focus on following that price. And I'm using moving averages. Let's say, for example, I'm using the 50-day exponential moving average. if the share price is currently trading above the 50-day moving average, then I will just keep on trailing that price. As it goes up, as it remains above the 50-day moving average, I'm happy with that particular position. But as soon as the share price closes below the 50-day moving average, after it has been respecting it, not closing below it, then I sell my position, because the next thing that can happen is that the price is now going to start trading below the 50-day moving average. Then I don't want that, because now it means that I will start giving back my gains back to the market. Remember, time is money. You don't want to make profit in the stock market and then leave that profit back in the market. And the reason why they do that, we normally, when we speak about investing or trading, there are two emotions that normally drive people. It's fear and greed. When you see an opportunity happening, people are talking about Brico, you have that fear of missing out, what people call FOMO, right? So you just jump without even doing your homework to determine that if Brico is your best investment. So that fear makes you not want to miss out on some positions. But at the same time, when it's time to cover your position, you start to think. Then even greed then starts to kick in, because if you bought at 800 rand and now the share price is at 125, you are sitting at 25% profit. Then in your mind you are thinking that, okay, excuse me about these bets, yeah. So once the share price reach 125 rand, now you're up 25%. Now you fear that if you exit at 125, the share price can go up. So it's fear. Now it's a combination of fear and greed, because you don't want to exit. You think that it's too early. If you exit now and the share price go to 150, you're going to miss another 25%, right? And it's greed that is driving you, because you think about the amount of money that you're going to make once the share price it reaches 150, and then maybe it goes to 130, then it starts to come back to 128, 125. Now you don't know what to do on that particular position. You start to hope that, okay, it went from 100 to 130 to 125, then 130, now it's going back to 125. It's possible that it can recover, go back to 130 and maybe go to 135. You see, and then it doesn't. It goes to 115, then it goes to 100, then it goes to 95 rand. Now you are losing money. You see, you are just sitting for too long in that particular position, because fear and greed drove you. You feared you feared leaving some money on the table, but also greed made you to want to think about the money that you haven't made. Look, you understand, if you buy a company for 100 rand per share, you are spending your capital. But once the share price it goes to 120 rand per share, your capital is no longer 100 rand. Now your capital is 120 rand. Your responsibility, it is your responsibility to protect your capital. Don't make money and leave money back in the stock market, because then you are just wasting time. You shouldn't be in the market in the first place if you wouldn't know how to act when the stock market behaves, right? So I think that's all that I wanted to cover today. So in terms of selling, you're going to sell when the stop losses hit, and also you're going to sell when you're using a time stop, when the share price is not going anywhere, it's just wasting your time. Then in terms of selling for profit, closing your position because of profit, if you are a swing trader, you have a predetermined take profit level. Once it's hit, you exit. Don't try to rationalize it that you still like the company and all those kinds of things. That is just fear and greed kicking in. You stay in that position for far too long, you might end up giving the gains. So with swing trading, you need to have a predetermined exit levels, both for profit and loss. Once they are hit, you exit. Swing trading, the success of swing trading comes from turnover. It does not come from holding one position for a very long time so that you can say you have multi-pack. You make 30% on this name, you move on to another name, you make another 30%, you move on to another name, you lose 10%, you move on to another name, you make 20%. Once you combine all these returns, then it's easy. You could just be up over 20-30% just by hopping between companies. But that is for traders. You also need to be mindful of the tax that is involved with that. We're not giving you a tax advice or even financial advice. We're just sharing our experience with you. right? Then I said with trend following, you can just follow the price. That one is a bit more of a long term. You sort of an investor, but that use a technical analysis. I didn't cover how people would close positions based on a fundamental analysis, but there's no need. It doesn't matter which approach you are using. There's no need to stay with the company if the share price is moving against you, because you don't know how long it's going to fall and move against you. So it's important that for your own sane, so that you stay sane, you don't become insane, you need to ensure that you cut your losses real quick. For me, I don't want a position that goes beyond minus 10%. I don't know how many times I'll have to exit and buy that position again, but I'm not going to sit there and start to rationalize that, yeah, but Metaverse is still a good company, or Netflix just signed up 300 new subscribers. I don't care about those stories, because those stories, they don't help me in any way. I'm losing money, but I'm trying to justify why I need to continue holding on to that particular position where it is evident that it is not working. So it's important that you take your stop loss. I think I've said enough today. I hope that I've covered the question in a proper way, that the person that asked the question is satisfied, and anyone that was wondering when they should exit the market, whether for profit or loss, I hope that this video help to bring some a bit of clarity. So I would like to ask you, if you enjoyed the content of this video and you haven't subscribed, please consider subscribing. And if you, again, if you enjoyed this video, please smash that like button. If you have any questions or comment, leave them in the comment sections there. I respond to all the questions, well, unless it's a spamming message, but I respond to all the messages. Thank you. That's it for today. I will see you on the next video.